This video will walk us through the percentage of completion when we deal with long-term contracts. In the last video, we talked about completed contract extensively. We gave you a bit of background on what a long-term contract was, why it exists, and then the mechanics of the completed contract version of accounting for long-term contracts. Under this methodology, there are some similarities. Okay, so the core of this model is identical to that of the completed contract. If you remember from the completed contract method, we talked about 3 journal entries we do every year no matter what. We need to recognize the expenses that we've incurred, we need to record the billings we've invoiced to customers, and we need to recognize the payments that they've sent our way. So those 3 things, the costs we've incurred, what we've billed them, and what they've paid us. Those entries are standard. I'm not going to spend a lot of time on them in this video because you went through them in the last video, but they're identical under both methods, and again, they're required every single year no matter what, okay? The main difference, though, between percentage of completion and completed contract is that percentage of completion is going to recognize a little bit of revenue each year as opposed to waiting till the end of the contract, okay? So revenues and expenses and profit are going to show up on the income statement every single year, and they're based on an estimate of the percentage of the job that's complete. And for our purposes, we'll be focusing on calculating that percentage of completion based on expenses. Okay, so how much have we incurred to date versus what do we think the total project's going to cost us? That's how we're going to come up with our percentage of completion. Okay, so why do we do this method? It obviously provides more timely information on our financials. Right? We don't have to wait until the end of a 2 or 3 or 4 year project to recognize revenues and expenses. We're showing our progress on a year-to-year basis, which is obviously more useful for our readers. Okay? So you'll notice that under the percentage of completion method, there's actually 4 entries that you do every single year, again, no matter what. So you do this first 3 standard entries that I already mentioned. The 4th entry is an entry that's going to recognize your revenue, where we actually post a little bit of the revenue to the income statement. So there's a new journal entry we're going to look at when we go through this chapter. Okay? Progress billings are still posted to the BOC account, billings on contract. Costs incurred are still posted to the PIP account as always, but now we have an extra revenue entry. So there's a few equations that you actually need to know how to calculate, and these could be there's a few equations that you actually have to know how to calculate. And these could be actually reversed on this slide. The first thing that we're going to have to do is we're going to have to calculate the percentage complete. The way we calculate the percentage complete, there's a few things you focus on this very specifically. Percentage of completion is the total costs incurred to date, okay? To date is key. So total costs incurred to date. It's not the cost for the current year, it's all of the costs that we've incurred for the entire project thus far. So if we're in year 3, costs incurred to date are all the costs from year 1, plus the costs from year 2, plus the costs from year 3. Those are costs incurred to date. We're going to divide that by the most recent estimate of the total cost of the project. Again, pay attention to the wording. It says most recent estimate. So if we're doing year 3, it's the estimated total cost of the project from year 3. Okay? If we're doing year 2, it's the total estimated cost of the project from year 2. Another thing to focus on is what is the total cost of the project? Okay? Well, the total cost of the project is everything that we've already spent plus what we think we still have to spend to finish the job. So think of a basement renovation. So you're renovating your basement, and I'm the contractor, and I've been working on it for 2 months, and you come down one day and you ask for a progress report, and I say, well, we've already spent $15,000 on the basement, so costs incurred to date were $15,000. But I still have to hang the drop ceiling, I still have to paint, I still have to put in the carpet, I still have to put up the baseboards, and there's some extra finishings that you want. The pot lights have to be put in. So I'm going to estimate that it's going to cost us another $5,000 to finish it. So we've already spent 15, and I have to spend 5 to finish it. Now that 5 is just an estimate, right? That's my estimated cost to complete. What's the estimated total cost of your basement renovation? If you think about it logically, it's everything we've spent which is the 15,000, plus everything we think we have to spend to finish it, which is that other 5. So the estimated total cost is $20,000. Same thing with a long-term contract. The estimated total cost of a project is everything we've already spent plus what we think we might have to spend to finish it. That's how I get to my estimated total cost. Okay? So when you take everything that you've finished to date, use that basement renovation example. We had incurred $15,000 in costs to date, so the total cost incurred to date would be $15K. And then we thought it was going to take another 5 to finish, so 15 plus 5 made the estimated total cost $20,000. So my percentage of completion is 15,000 divided by 20,000. So my estimated cost of, my percentage of completion is 75%. 15 divided by 20. Okay? I'm then going to take that percentage of completion and I'm going to use it to help me calculate the total contract revenue. So the formula for the contract revenue, okay, and this is how much revenue we want to recognize in the current year. What we're going to do is we're going to take that percentage of completion, and so for the basement renovation it was 75%. We'll take that 75%, right? And we're going to multiply it by the total contract revenue. So say you agreed to pay me $25,000 for the basement renovation. The costs are 20 estimated, and the revenue is 25 for me. So I have a $5,000 profit margin I'm expecting. I'm going to take that 75% of the basement I'm finished. I'm going to multiply it by the total contract revenue of 25,000, and I'm going to subtract revenue previously recorded. Again, focus on the wording. It doesn't say revenue from the previous year. It says revenue previously recorded, which means revenue from every prior year. If I'm doing this for year 3 of a project, I would take the percentage of completion times the total contract revenue, and I would subtract the revenue from year 1 and the revenue I recognized in year 2. That would give me the revenue recognition figure for year 3. Okay, so that's how those two formulas connect. Whatever I calculate as the revenue recognition for the year, that goes straight to my journal entry. I'm going to credit construction revenue for that amount. All right, so if we take a look at the journal entries for percentage of completion, there's your 3 standard entries. You're going to do those every year no matter what. The first one is the costs incurred to date, or is the costs incurred during the year, sorry. The second one records what we billed the customer during the year, and that third one records what they paid us. Okay, those are the exact same as the completed contract method. Okay, but at the end of the year we have a 4th entry now. So for now, every year we have a 4th entry. If you look at this one, look at the credit first, that credit to construction revenue. That's the calculation we just did on the previous slide. Whatever I calculate as my revenue recognition figure is going to get slotted into the journal entry as a credit to construction revenue. Okay. The debit, look at the first debit, it says cost of construction. That's an expense on the income statement. And I'm going to debit cost of construction for the costs incurred during the current year only. Not year to date, costs incurred during the period. Okay? So it's not project to date, so it's not for the first 3 years. If I'm doing year 3, that debit to cost of construction is only the expenses that I incurred in year 3. Okay? So I credit revenue, I debit expenses. If you think about this logically, this isn't going to balance. Our revenues don't always equal our expenses. We're going to either need a debit or a credit to balance. And it doesn't matter if it's a debit, it doesn't matter if it's a credit, it will always go to your PIP account. Right? So that construction project in progress is your PIP account, your inventory account. Okay? We've now recognized some profit on the income statement. Right? We've credited a revenue and debited an expense, so we've satisfied that percentage of completion methodology saying we want to recognize a little bit of revenue each year. The profit is accumulated in the PIP account. Okay? So again, we have 4 entries every year under percentage of completion. Record the costs incurred, record what we invoiced the customer, record what they paid us, those are those standard 3, and the last one is a revenue recognition entry, which is on this slide right here. Okay? We do those 4 entries every single year, no matter what. We have actually one extra entry that we need to worry about, and it happens in the final year. Okay? So think of this as maybe a 3-year project. In year 1, we do these 4 entries. We record the 3 standard ones in our revenue recognition. We do the same thing in year 2, and then we do the same thing in year 3. By the end of the project, we've recognized all of the contract revenue, we've recognized all of the contract expenses. But we still have that PIP account and that BOC account, that billings on contract, we still have those sitting on our balance sheet. They can't be there because the job is done. The project is over. We've handed over the keys to the building and the ship or whatever the project was. We've handed over ownership. Okay? We've recognized revenue. We can't have an inventory item sitting on our books anymore. We need to clear it out. Well, the way you clear it out is to debit billings on contract for the total contract value and to credit PIP. So you close the two inventory accounts out to each other. One of because of the way this model works, at the end of a project, your PIP account will always equal your billings on contract if you've done the journal entries right. The reason being, you recognize all of your revenues in your BOC account. So when we're invoicing the customer, instead of crediting revenue, we're crediting BOC, right? In your PIP account, you're recording all of your expenses, plus, because of this entry right here, you're recognizing all of your profits, okay? And if you think of your standard, sales and profit calculation, you can visualize this fairly well. Okay, so imagine we have sales of $100. Okay, so our sales are $100, and we have cost of goods sold of $80. Right, so profit is $20. Write it down if you need to follow through this example. So we have sales of $100. We have expenses or cost of goods sold of $80, which leaves us with profit of $20. Right? Think of the journal entries we do. When we invoice them for that $100 under this model, right? We put that amount to the BOC. So if you drew a T account, we'd have $100 in the billings on contract, right? Now draw the T account for the PIP account. When we recognize our cost of construction in those standard three entries, that $80 that we incurred in construction costs would be sitting in the PIP account. So debit PIP for $80. Fill that into your T account. So we're now sitting with a BOC account that has $100 as a credit, and we have a PIP account that has an $80 debit. They're still not balanced. But look at this revenue recognition entry that we would do. If this was the only year, or if this was just the information for the current year, we would credit construction revenue for $100. We would debit the cost of construction for $80, and this debit of $20 would go to the PIP account. Profit goes to PIP. So because of our standard formula, profit plus costs equals total revenue. If you don't understand it, draw it into your T account. Under PIP, you should have $80 for the expenses, and you should have $20 for what you just put in there for profits. So at the end of a project, your PIP is always going to equal your billings on contract, your BOC account. So to get them off our books, we just debit BOC and credit PIP. Okay? So again, percentage of completion, 4 entries every year, no matter what. Your 3 standard entries. Record your costs to PIP. Record what you invoice the customer, that goes to BOC. Record what the customer paid you, right? And then the final entry is this one on this overhead, which is a revenue recognition entry. So those 4 entries every year, and then in the final year of the project, you have this one last entry to debit billings on contract, credit construction project in progress. So we talked about this before. How do we choose which method? Again, it's not intended to be a free choice. We have to do percentage of completion if we can if we can reasonably estimate the following 3 items: our progress towards completion, the estimated cost to complete the project, and the total revenue. In the vast majority of projects, we are going to be able to do these 3 things. So if all 3 of those criteria are met, then we have to use percentage of completion. If not, then we can use completed contract. The one caveat here is that under IFRS, progress towards completion, even if you can't measure one of these 3 items, you still have to recognize revenue every year, okay? Which means we have to do that 4th entry every year. The only difference is if we can't estimate percentage of completion, all we do is we recognize revenue in an amount equal to the expenses that we incurred in the current year. So even though we can't estimate percentage of completion, if we incurred $300,000 worth of construction expenses during the year, we recognize $300,000 of construction revenue. Profit is zero, but we've recognized a small portion of the contract on our books. Okay? So let's see if we can take a look here at a question really quick. Okay, these are on FOL. We've got a quick example, and I'm not going to go through in crazy detail the first three entries because they're standard. You've done them, and we did them in the completed contract. So under requirement 1B, they want us to complete all journal entries for all 3 years, assuming the company uses the percentage of completion method. So we have a contract revenue of $15.5 million. I've given you some information on costs incurred during the period, estimated cost to complete, billings during the year, and progress payments received. Okay? So again, this is asking us to do all required journal entries. Under percentage of completion, you should know by now we have 4 entries to make. The first is to record the construction costs incurred during the year. And like I said, I'm just going to go through these quick because these were in the completed contract method. So we're going to debit our PIP account, right? And this could be PIP. We're going to debit our PIP account, and we're going to credit cash or AP for the costs incurred during the current period. We're doing this for 2008. Okay? The second entry is to record what we billed the client, and we billed them $1.75 million. So I'm obviously going to debit AR, and I'm going to credit billings on contract, that BOC account. Okay? The third standard entry we do every year is to record what the customer paid us. And in 2008, the customer paid us $1.6 million. So I will debit cash, and I will credit accounts receivable. That's a standard entry from when you get paid by a customer or client at any time. So we have our fourth entry that we need to do now. We're not quite done. We have the fourth entry to do, which is our revenue recognition entry. But at this point, we're not in a position where we can actually calculate the revenue or complete the revenue recognition journal entry because we don't know how much revenue to recognize. We're trying to determine how much of this $15.5 million should we recognize. So step one is to always come up with the percentage of completion. Okay? If you go back to the overhead slides, or if you wrote it out, or if you're looking at the text, you'll remember that the percentage of completion calculation is the costs incurred to date, right? To date is key, divided by the estimated total cost of the project. Okay? Now on the test, I only need to give you these 4 lines. You may have to calculate estimated costs incurred to date and estimated total cost of the project. They're not very hard to do, right, if you remember the methodology. So estimated total cost of the project, remember when we looked at the overhead slides, I said estimated total cost of a project is everything we've already spent on the project plus what we still have to spend to complete the project. So in this case, in 2008, we've spent $1.875 million on the project, and to complete it, we have to spend another $12,475. So if you add those two items up, we end up with, $12,475,000. So if you add those two items up, we end up with $14,350,000 in estimated total project costs. So again, the journal entry or the formula is costs incurred to date divided by total estimated cost of the project. So if I take 1.875 million and I divide by 14.35 million, you'll find that the percentage of completion is 13.07%. So now we can use that 13.07% and we can calculate our revenue to recognize. Okay? Again, the formula for revenue recognition is percentage of completion times total contract revenue minus revenue previously recorded. Well, because this is the first year, there's no revenue previously recorded, right? So my formula for revenue recognition is just this 13.07% times the $15.5 million. If you run that math, you'll end up with $2,025,850 as your revenue recognition. Now, I've rounded this number to 4 decimal places, so if you don't round, this number will be different. Okay? So that's my revenue recognition. Now that I know that, I can do my fourth and final entry for the year, right? We just calculated construction revenue, so if this was me, I would just quickly get it into my journal entry. So we calculated construction revenue to be $2,025,850, so I credit construction revenue for that amount. Okay? Then you have to offset that. If you think about it logically, we have revenue on our income statement now, but we don't have any expenses. So I need to offset that revenue with my construction costs. And because the income statement is a temporary statement, the accounts on it are temporary, we're only looking at a current year, 1 year. We're not looking at the full life cycle of a project. So when I debit construction costs, it's not for costs incurred to date, it's for costs incurred during the period. And now in the first year it doesn't matter, but in subsequent years it will, right? So my construction costs incurred for the year were $1.875 million. Okay, so you can see that we don't have a balanced journal entry at this point. Okay, so we need to balance this journal entry, and the difference between these two items is $150,850 debit. That's what I need to balance. Okay, your plug, your balance, which is the profit for the current year or loss, depending on the situation, will always go to your PIP account. Okay, so we're going to plug the difference to PIP. And it's the same way every year, and it's regardless of whether it's a debit or a credit, that plug is going to go to PIP. Okay? So percentage of completion, 4 entries. Okay? Record the revenues, record the expenses, plug the difference to the PIP. Okay? Now, we can go back and we can do 2009 and you can do 2010. The solution's there for you in FOL. But I'm going to quickly fill in what would have happened in 2009, right? Again, do all the journal entries for a given year. Those first 3 entries never change. The debits and credits never change. The only thing that's different is the amounts that were incurred for the year. Okay? But what I want to focus on is calculating the percentage of completion and the revenue recognition for 2009. Okay? So again, percentage of completion is total costs incurred to date divided by the estimated total cost of the project. So the total costs incurred to date in 2009, right? And it's to date, which means for the life of the project, which means we spent $1.875 million in 2008, and we spent $5.875 million in 2009. So if you add those two together, your total costs incurred to date at the end of 2009 are $7,750,000. That's the numerator for my calculation. The denominator is my total estimated cost of the project. So again, remember, total estimated cost of the project is a function of everything we've already spent plus what we still have to spend to finish. So at the end of 2009, we've already spent $7.75 million and we still have to spend another $6.75 to finish the job. So the sum of those two items means we're now expecting the project to cost us $14.5 million. Okay? So my percentage of completion is based on the fact that I've spent $7.75 million on an expected $14.5 million project. So if I take what I've spent divided by the total cost, it's going to give me a percentage of completion of 53.45%. So I'm over halfway done the project. So by the end of 2009, I should have recognized over half of the contract revenue. Makes sense, right? Okay, so the revenue recognition entry, now that I have the percentage of complete, I can finish it. Revenue recognition is the percentage of completion, which is 53.45%, times the total contract value, which is $15.5 million, subtract revenue previously recorded. And if you look back here in 2008, we recognized $2,025,850. So I'm going to take 53.45%, multiply it by $15.5 million, and I'm going to subtract the $2 million in change that I recognized in revenue back in 2008, and it will leave me with a revenue recognition figure of $6,258,900 for 2009. So again, my journal entry is going to be a credit to construction revenue for the number we just calculated, right? A debit to my construction costs, and again, this is for the construction costs incurred during the current period, which was $5.875 million. It's not the costs incurred to date, it's just for the period. Again, I have an unbalanced entry, so the difference between those two is $383,900, and I plug it to my PIP account. Okay? So that's all there is to it. We do those 4 entries every year. If you were to go back through and do 2010, you would do all the same steps. The one trick is that in the final year, the project is always 100% complete because it's done, right? If it wasn't done, or if it's done, it has to be 100% complete. Otherwise, it's not complete. So you don't have to calculate percentage of completion in the final year. It's always 100% done. So really, all you're trying to do in the final year is figure out what portion of this $15.5 million do I still need to recognize based on what I've already recognized in the first 2 years. Okay, that will flow through to your journal entry. The final step in 2010 is to close out your PIP and your BOC account, right? And remember what we said before, the way you do that is to just close one out to the other. Your PIP and your BOC account at the end of a project will both have the same amount in it, and it will always be equal to the total contract revenue. So to close these out, I'm going to debit PIP and credit BOC for the $15.5 million. If you can't see that, draw out the T accounts, do all of these journal entries, and post them to the T accounts, and you'll see how you get to the $15.5 million in both accounts. All right? So that's it for the percentage of completion. Practice the examples that are online. Practice the questions that have been assigned in the text, and you guys should be in great shape for the exam. If you have any questions, just email me.